It's interesting because they put maintain the world reserve currency in the GOP platform.
Mm.
And him and his Treasury Secretary and his group around him has explicitly said we want to keep the dollar as a global reserve currency, despite the fact that we want to address the trade balance. Without a lot of talk about that's what's fueling, those are kind of two halves of the same thing. Now, the person in his orbit that probably gets that the most from my reading is Stephen Miran, I believe is his last name. He's been nominated to be his head economic advisor.
Mm-hmm.
And he's the one that's done a lot of work on this, saying that some of these policies might be dollar strong initially, but then later dollar weak. Technically, there is a difference between how cyclically strong the dollar is and whether or not it's the global reserve currency. So Trump has talked before about other currencies being unfairly cheap, talking about potentially exchange rate differentials as part of a negotiation, like intentional dollar weakening. And you can have a burst of intentional dollar weakening while still being the global reserve currency. So I think that's probably the trade-off that they're willing to make, which is to risk some inflationary outcomes, potentially do a dollar devaluation once they get some of their initial tariffs and concessions and things like that set up. I do think they'll probably look at the currency differentials. And some of those economists have even talked about trying to disincentivize other countries from holding as many U.S. assets. And kind of boosting up artificially our asset values and our exchange rate. But there's kind of like how there was losers on this past 40-year trajectory. There'd be losers if you just kind of start reversing all that. The losers would become the winners. A lot of the winners would have to change things to stay winners or would be losers. And therefore, you probably have pushback by certain corners of the economy at those policies. And even if you didn't have pushback, just the sheer trend of trying to turn a major trend is hard. And then especially because a lot of people that want this trend changed don't necessarily know some of the trade-offs of why those trends are in place and what some of the sacrifices might have to be done to reverse them. With that approach, the only way to pull that off is to basically approach things like a zero-sum game, to say that there's this board out there and we want a bigger share of the board. And so we can, like the last several decades, ever since the fall of the Soviet Union, we've had kind of the U.S. is kind of, it's a unipolar world, and there's a lot of kind of international working together. And the downside is that some of these really big imbalances build up. They build up within the Eurozone, and then they've also built up with this U.S. Whole trade deficit situation. Now we're kind of going more toward like every country for themselves, or every block of countries for themselves, more multipolar. And I think that one of their mitigants is basically say, look, there's going to be downsides of our policies, but we're going to try to make as many of those downsides as possible not in the U.S. I think the biggest risk there is that more of them will be in the U.S. than they probably realize. Generally speaking, that's most politicians, the way they do things is they'll promise things and then minimize the downside. So you want to give people tax cuts, but you don't want to emphasize that this might result in a bigger deficit, for example. You might want to do XYZ, but not necessarily want to admit that ABC is kind of a cost of getting XYZ. So I think that's probably what we're seeing here, which is they want a lot of things and some of those things potentially conflict. Right. So it's been fairly strong. It's been in a strong cycle for about 10 years. Really, in the 50 plus years of being this kind of floating exchange rate, post Bretton Woods environment, there's really been like only 3 major dollar cycles. So they did really strong into the 80s, and they did the Plaza Accord. Then they got really strong into the late 90s, and then that had a big weakening. And then we've really been strong ever since 2014 or so. So we're about a decade into a fairly strong band of the dollar. Now there's weakening years like 2017. There's really strong dollar years like 2022. But a lot of that is in the context of being on the kind of the higher side of that strong dollar cycle. And I think there's a couple different factors for that. One is these ebbs and flows generally happen because of quantitative easing, interest rate differentials, the strength of the economy. And I think what we're seeing in recent years is a lot of own goals in those other currency environments. So Canada, for example, not wanting to build some of its like energy infrastructure out for environmental reasons. And if you look at their GDP per capita compared to the US per capita over the past decade, it's not even close. They've had basically no growth, and we've had pretty good amount of growth. Same thing with Europe. There's some of their energy policies, and then they they paid a lot of the price when they lost Russian gas, because that wasn't really part of their plan. And then they haven't really tackled that head on, I would say. And then China has also purposely trying to deflate a property bubble, which is noble. But then they also bit off quite a bit because they went after their own big companies in like 2021, kind of the whole like anti-Jack Ma, anti-big tech titan type of play they did. So it's like, okay, you're going after your property while also going after your equity market, while also their COVID policies were not as effective, and they really kind of lean into that, and they lost kind of credibility there. So a lot of these other big currency blocks have had kind of some of their own goals, whether energy or otherwise. And so I think that's contributed to this dollar cycle probably lasting longer than it otherwise would have, because a lot of investors look around and say there's really no other game in town, at least among big regions. And then with the dollar index specifically, a lot of that is the euro, which is kind of a problematic structure of a currency. And then the dollar's had a big kind of post-election surge, and that's partially because, okay, they're expecting potentially looser fiscal policy, which is debatable because of the whole Doge approach, but that's kind of what the market was looking at. Higher inflation expectations, and therefore pricing in a more hawkish Fed, which generally implies stronger dollar, at least for a period of time. And it also goes back to Trump's head economic advisor saying that some of these policies will likely be dollar strong initially, and then either dollar weakening over time, or as we do purposeful dollar devaluations after we get those first things in place. I think it would be good for another cycle. I think that kind of buys some time. And Plaza Accord's based after the hotel it was in, so this one would probably be something like the Mar-a-Lago Accord. So he has talked about currency differentials more than, say, Biden did. It's clear that's something on Trump's mind. And if we do see ongoing negotiations around these tariffs and things like that, we could see currency components in there. The initial Plaza Accord was done for similar reasons, which is when in the earlier phase of this hollowing out started to happen, where Japan was basically eating our lunch, Taiwan was eating our lunch, like the foreign cars are coming in, and like, we're having a very strong dollar environment because the Volcker had done really tight monetary policy trying to curtail inflation. All these factors made the dollar strong, made it hard to manufacture things. So they intentionally did this to kind of assert U.S.'s desire to not be so imbalanced. And so they absolutely could do that again. The question is, will they? I don't know. I mean, some people say that the weakening of the currency in 2017 was kind of a hidden accord of this type, where like the U.S. and China kind of work together. They kind of sometimes informally call it the Shanghai Accord. There are probably periods of time, moments of intentional movements. Now, the Plaza Accord was a particularly big one. And I do think that there's a chance we would see a similarly kind of cycle-ending move, and therefore give another kind of whole 10, 15-year cycle to this whole kind of dollar ebb and flow that it's been doing ever since we ended the Bretton Woods system. There's a couple moving parts there. One is counterintuitively, when the dollar's strong, it generally means that foreigners stop buying our debt. So we've already seen over the past 10 years, foreign central banks have not purchased our debt. And some foreign buying that has occurred has been in the private sector, but it's generally not been as much as the domestic sector. And so some of these like poor liquidity environments are because the dollar is so strong, it's hurting our assets. One of the biggest examples was in 2020 during the heart of the COVID crash, the dollar spiked and the Treasury market literally broke. Like it kind of certain securities just kind of went no bid. And so that's when the Fed had to really kind of step in and do the fastest ever QE that we've seen, and all sorts of emergency swap lines and things like that to basically tell the foreign sector, please stop selling our treasuries. We're going to supply dollars. And for people that don't kind of follow this, anytime you have a debt, that is like an inflexible demand you have for the currency that the debt's denominated in. And across the world, there's something like 13 trillion in dollar-denominated debt outside of the U.S., and most of it's not even owed to the U.S. Like an entity in the U.K. will lend dollars to an entity in like Indonesia because it's the global reserve currency and it's the ledger that both of those countries and entities can agree to use. And the problem is that there's more dollar debt than there are base dollars. And the foreign sector also has a lot of dollar-denominated assets, stocks, bonds, real estate, things like that. And sometimes the entities that own a lot of those assets also have a lot of the debt. Sometimes they're different groups, and sometimes they're overlapping groups. And generally speaking, when you get a strong dollar environment, the whole world kind of gets slowed down a little bit. They're in more currency defense mode. They're not accumulating reserves as rapidly. If anything, they could be selling treasuries to support their own currencies, and that can ricochet back into U.S. markets and give us all sorts of turbulence, like in 2020, like in 2022. These things can happen. And so by weakening the dollar, they ease the debt burdens of a lot of emerging markets in particular. That gives them a little bit of a boom, which is generally comes back and helps U.S. asset prices and U.S. economic growth as well, keeps them happy, and then kind of keeps the whole cycle going. And of course, one of the big costs of that is it can keep inflation sticky, because if you weaken the dollar, you can get higher energy prices, marginally higher import prices, and kind of, have that trade-off.